For a look at the wider picture, we're joined by Virginie Maisonneuve, Head of Global Equities at Schroders Investment Management. Thank you so much for coming in to speak to us. I want to start by asking you about comments we were hearing there from former Fed Chairman Alan Greenspan saying that if house prices in the US rise any further, it could tip the US back into recession.
Well, I think the U.S. economy is in a very volatile state at this moment. We've seen a lot of very weak data in terms of, consumer demand, unlike in the industrial sector, where actually companies have been doing very well. So we still have this sort of plus and minus, macro data very volatile, and companies' data being very strong. And clearly the market doesn't like this.
It seems to be the perfect storm, doesn't it? You've got a disappointing GDP number showing the US economy is perhaps slowing down, and at the same time China is possibly facing a dip as well.
I think China is in a different stage. I think what we'll see is that the third quarter is going to be the trough, and the fourth quarter is actually going to be better. What we're seeing right now is really the results of what we've done in the past 6 months and before, where we've withdrew the stimulus. We have to remember that we have a new 5-year plan coming up, and a lot of details are going to be announced at the October government meetings. And I would expect that by then we are in a better shape from an economic environment that we are now.
Now, the latest data from China, just looking at a chart there of that, does a dip in manufacturing necessarily have broader implications for the Chinese economy as well? Does it necessarily mean that the economy is slowing down? How much can we read into this figure?
Yes, I mean, a lot of the stimulus plan was about fixed asset investment, if you remember, and we've taken some of that back. A lot of the investment was also linked to property, which was growing way too fast, so the government wanted to rein that in. That is actually very positive. I think that
so those measures are working?
They are working in slowing down, and because we're in the last year of this current 5-year plan, it would be normal to have a second half growth slower than the first half. And if you remember, the first quarter numbers were very, very strong, close to 12%. I think this is very healthy, and that the trough will be in the third quarter.
You say it's very healthy. Nevertheless, what could it mean for the global economy, given that China has been very much the engine of growth through the course of the global financial crisis?
Well, even if we have a slowdown in manufacturing, what really China is targeting is a very strong pickup in consumer and service industry. So I think it's understanding how those two parts move together or not, that the world will be impacted. The next couple of months might again, show some sign of weakness, but I think after that we'll see more demand coming out of China, particularly in the fourth quarter.
So what does this mean for the global economy?
I think for the global economy, in the short term, the markets will continue to be volatile, looking at this data. However, a lot of this should be in the price already, because remember, we've started to take the stimulus back quite a few months back, and we've certainly talked about it within the government since October last year. So this is not new.
Now, we're expecting some Spanish economic data in just a few minutes from now. What are your expectations?
Well, I'm not a macroeconomist, I'm a stock picker, so it's a little bit difficult, but I think expecting some weakness and continued weakness would be absolutely normal. Here again, if we look at the southern belt, I think we should expect more structural adjustment. If you look at all the budget cuts that need to happen, I think that is what we should expect, and I think next year will be in a slightly better environment.
Because Spain suffers from a very high stock of private sector debt. How much of a threat does that pose to its banking system?
Well, it's still very large, particularly because of the exposure to the property sector that it has, over 300 billion of loans made to property. So I think what's very important is that because we've had the bank stress test and because we've had Basel III, the market is relieved. It sees some direction. We must remember that sovereign risk is not gone.
Well, thank you so much for putting all that into perspective for us. Thank you very much, Virginie Maisonneuve, Head of Global International Equities at Schroder Investment Management.